to the 2 o'clock hour, and then I'll admit all that's in the waiting room and just keep adding people as they show.
Perfect.
All right, I'm gonna let is in, and then trickle the rest in if you're good with that.
Yeah, let's roll.
All right, buddy.
Hi, Bob.
Oh, just a minute.
No, you're unmuted. I can hear you. I can see you.
Good afternoon, everybody. Welcome to our fourth quarter webinar on what to expect the rest of the year. And we do have a few people still trickling in, so we're going to get going here in just a minute. Allow those that have joined to get connected, and then we'll get going. Okay, well, we are 1 minute
Can't
past.
hear if you can hear me.
Bob, we can hear you just fine. I'm going to put you on mute, and your audio settings are at the bottom. Okay. Will, we are 1 minute past, so let's go ahead and get going. Welcome, everybody. I'm Ben Mendenhall, the administrator of the Centennial State Liquid Investment Pool. Been serving Colorado local governments for going on 20 years now. I've worked with many people in this room. And with us, we do have Mr. Krug, director from Centennial State Liquid Investment Pool, and Will Goldthwait, who is our portfolio strategist from State Street Investment Management, who serves as the investment advisor and also the portfolio manager for the CSLIP fund. So we are honored to have everybody back. We see some familiar faces. We see some new faces, which is always great. Today is designed to provide some in-depth information and forecasting for what the next quarter of uncertainty looks like. And with that, I'm going to hand it over to Will to discuss a little bit about his background and a necessary disclaimer before we get going.
Thanks, Ben. Great to be here, everybody. Hope you're having a beautiful sunny day in Colorado, as I know you probably are. I'll just introduce myself and then I have to read a quick disclaimer because my compliance folks insist I read this. So my name's Will Goldthwait, as Ben said. I've been at State Street for 11 years. I've got about 35 years of industry experience, always in the front end of the curve, the cash and liquidity portion. I was in sales for almost a decade, and then I was a portfolio manager on a couple different money market funds for almost a decade, and then I've been in this role for just over a decade. So pleasure to be here. But before we get started, I Do have to let you know that this webinar is intended for the confidential use of CSLIP and their clients and prospects. It's not open to the press. Any review, dissemination, distribution, or copying of this webinar is strictly prohibited. Comments made by the speakers, Ben and me, are their opinions and not that of their respective firms. The comments do not constitute investment advice or analytical research and should not be relied upon as such. We are recording this webinar on November 4th at 2 p.m. Mountain Time. So that's that. We got that out of the way. We're ready to go, Ben.
Yes, we are, and we still do have a few people trickling in. So thank you for that. Well, what a what a interesting couple of months. Is probably the easiest that I can put that. Certainly a lot of market turbulence, geopolitical turbulence, just turbulence, all over the place. So I mean, one of those quarters where do we even start? I guess let's dive right in on the most recent Fed rate cut, and we can kind of expand from there.
Absolutely. I'm going to apologize in advance if you hear a dog barking. I'm doing my best to get this guy under control. It's my daughter's dog, and he's staying with us for a little bit. So I'll try to mute myself quickly, but just want to let people know that that could happen. Okay, so let's just go right at what happened last week. Chair Powell said something that so we got 25 base point rate cut as we all know, and Chair Powell said a couple things that were pretty interesting for us. We had two dissensions. One that was fully expected, that was Stephen Mirren, who dissented and wanted a 50 basis point rate cut, and he has a whole series of reasons. And it's a very well thought out argument. I have to give him credit, and he's been on the speaking circuit, explaining exactly what his thinking is on why he believes that interest rates should be much lower. And then the other dissent was from a regional Fed president, name escaping me right now, that did not want to cut rates. So we had one wanting more, one wanting less, and then the remaining 10 voted to cut interest rates by 25 basis points. So I think that is interesting in that it is a confusing time. There is a lot of discussion and debate on where policy rates should be. There's obviously enormous concern about inflation. And so there continues to be a lot of debate about prices. And then continues to be a lot of debate about labor, about the jobs market. And that's a very confusing one. So there's a lot to unpack there, Ben.
Yes, it most certainly will. And I guess, do we have another rate cut guaranteed? Or, it seems like a lot of the forecasts, not only from State Street, but some of the other institutions out there have kind of changed course. What are your thoughts there?
Yeah, exactly. So it was anticipated that we would have one more rate cut. In fact, the Fed funds futures market, was pricing that in, and one more rate cut in December, making 3 rate cuts for this year. Chair Powell basically made the statement, when driving in the fog, you slow down. And the fog in this case is the government shutdown. We do not have economic data in a timely manner because the BLS is not working. We've gotten some bits and pieces of data in, which has given the Fed a little bit of confidence, but essentially they don't have enough confidence to proceed with another 25 basis point rate cut at this moment. That could change. It is anticipated. I think the latest opinions that I've heard is they think the government could reopen next week sometime. At that point, there could be a flurry. I mean, it just really depends on how the folks in Washington get themselves around the table and sort of figure it out. So that is the message. The message is when driving in the fog, i.e., you do not have the economic data in a timely fashion, then you slow down. Because listen, the last thing that the chair wants to do is convince folks on the committee, and that really is what his job is. His job is to build consensus um, and listen to people's very thoughtful presentations. Just as a reminder on how this all works, the FOMC meetings are 2-day meetings. They're Tuesdays and Wednesdays, but the meeting really begins long before that. Chair Powell, 2 weeks out, will start making the phone calls because that is when they go into quiet period or what's it called? Blackout period, where they're not allowed to speak to the press. They're not allowed to make any speeches. And so at that point, Chair Powell goes around to each member. There's 19 members on the committee. There's 12 voting members, but there's 19 total, and goes around and asks, okay, where are you? What do your models say? What are you thinking? How are you thinking? And then he tries to bring the committee together in a cohesive way so that they all can get to a point where they come out and they are united. Now, there's times when the market is very tricky and when people just can't come around to a particular opinion. And so that's when the chairman, that's when there's dissents. And dissents are not a terrible thing. Sometimes the news makes it sound like, oh my God, there's a dissent, like, holy smokes. When you look at the Bank of England's Monetary Policy Committee, the MPC, they often have votes that are like, that's a much smaller committee, but they're like 4-3 in favor of a cut or a hike. So I think we've gotten used to the fact that there is always consensus, but it by no means should it be that way. In fact, it's very ordinary and normal, in my opinion, for there to be healthy debate and differing opinions. So off the table. Now, what does that mean for next year? Next year, we had 3 cuts in place for next year, which would have brought Fed funds all the way down to that 3% level. And the reason we had that there is because we saw much more weakness in the job market. We are walking that back now. And we just don't think that there's any shot that the Fed right now has got 3 cuts in the pipeline for next year. But so we basically don't think there will be a cut in December, and then we think the next cut will most likely happen in March.
Okay, interesting. I remember talking to you on a few webinars earlier this year in February and July, where that forecast was much different, not only at State Street, but across the globe. So it's
Yeah.
always interesting, with what you and I talk about, how fast the landscape can change and the sentiment out there, as well as economic conditions. So very, very helpful information. And I just want to pause here for a minute for the group. If you have questions that you would like to send towards myself or to Will, feel free to type them in the chat. And if it's a timely question for our topic at hand, we'll go ahead and address it. If not, we are going to save some time at the end for the group. So this is really designed to provide as much information to you as possible. So with that, well, maybe it's a good time to talk about inflation or quantitative easing. Which one, or quantitative tightening, I should say. Which one do you want
Yeah,
to
yeah.
start with?
Yeah, no, absolutely. Both very good topics. So let's talk about inflation first. There's my friend. Sorry. Um, Inflation is so this is something that's very important. Inflation is the rate of change in price, right? Bad inflation is the rate of change in price. So, and Chair Powell made this statement in the press conference. Um, Chair Powell is trying to stabilize the change in price. So businesses, municipalities, so districts, et cetera, can plan, right? Everybody wants to know what you expect the cost of something to be. And so the idea is to be able to plan. So they want a very stable price construct out there. Now, with that said, Chair Powell's not going to get the price of groceries to come down. That's just not going to happen. So the challenge that I think the American consumer is facing right now is every time they go to the grocery store, every time they're paying their rent, every time they're trying to buy something, they're seeing that price, and that price is very different from where it was 5 years ago. And that is the struggle. Wages are catching up. When we look at wage inflation, it is above goods and service inflation. So it's catching up, but it's got a long way to go to catch up to all of those really dramatic price increases that we saw in 2021, 2022, and even into to 2023. Put on top of that this tariff news and trying to figure out what we're doing as far as what's the equilibrium? Where are we going to settle in on tariffs? That's a one-time price shock. The chair has said that he's looking through that. Um, but still, that is going to affect the things that we see in the stores and the things that we're trying to buy. That's going to affect it. And so that is going to be something that's also going to agitate and irritate consumers. Um, Now, where are we seeing some deflation? We're seeing some deflation in the household service sector. So what does that mean? Rents. Rents are coming down. When we look at national data, when we look at Zillow data, when we look at owner equivalent rent data, that those rents are coming off. There's anecdotes in certain areas where you're hearing that rents are coming off, and so that is a deflationary effect. And then other services, you can think of these as something as simple as restaurant services or other services in the economy are sort of trending sideways. So goods inflation, we're seeing a little bit of a surge right now. Uh, Rents we're seeing coming off, and then other services we're seeing going sideways. So this is also creating a confusing narrative for the Fed, and something that they're watching very closely. If it turns out that the tariff impact is more on the manufacturer and more on the intermediary and less on the consumer, then that could ultimately be good for the economy. If it turns out what our theory was, or what our forecast is, that it's going to be sort of a third, a third, a third, manufacturer, intermediary, and consumer, then there could be some near term pressures that will take a little bit while to work through.
Interesting. It's something that we're going to have to watch, very closely. And, how do you think that translates into quantitative tightening
Yeah.
strategy?
Yeah, so the quantitative tightening thing right now is pretty interesting. So they stopped QT, uh, but what we saw upward pressure in rates. This is good for our folks on the line here. That means CSLIP was the beneficiary of that upward pressure, because there's a lot of treasury supply in the market right now, and there's the primary dealers need to fund that treasury supply, and so they are essentially there's just upward repo rate pressure. The Fed is going to come in and try to do something about this. In fact, tomorrow they're going to come in with temporary open market operations. And so we'll watch that closely and see how that goes as far as pulling the repo rates back into the Fed funds channel. Right now, 3.75 to 4%, and we're trading just below 4% and above 4% today, and above 4% yesterday. So quantitative tightening is something we knew was going to stop at some point. It's just a matter of when, and the chair chose this past meeting to stop it effective December 1st. The thing that they will do is they're going to continue to let mortgages roll off and buy T-bills with that. And then with that should help stabilize the Treasury bill market, because we know Scott Bessent's really only option on funding the government is through the Treasury bill market, because there's so much demand there. When he tried to push on the back end of the curves, fives, tens, bonds, the market did not like that at all. And we have a Treasury Borrowing Advisory Committee meeting where there'll be further discovery on what the market can handle. And it just can't handle that much supply in the back end because the market is already spooked about the deficit spending that the government is doing right now. There's definitely a lot of concern on deficit spending. Nothing that is immediate problem, but down the road, there's going to be some challenges there.
Interesting. So calm really did breed chaos over the last 6 months.
Yeah.
That's fascinating. Maybe it's a good time to kind of ask you what's going on in the CSLIP portfolio. Given our most recent topics here, what are
Yeah.
you seeing in the change of duration of the fund, and how has that changed as a reaction?
Yeah. Yeah. Absolutely. I'll talk about that a little. And then I have some questions for you, my friend.
Okay.
Um, so CSLIP, the liquidity portfolio is humming along here. We've really worked very hard to keep the duration extended. We've worked very hard to keep it invested so that it can benefit when the Fed eases. We have our investment framework operates with a structural, cyclical, and tactical approach. So a structural approach is just things that always work in the portfolio through the cycle. So an example of that is buying asset-backed commercial paper. You get similar exposure to a bank name. It yields a little bit more, and so we do that trade because it's risk de minimis. Um, that's a structural trade. Cyclical trade is what is the general direction of policy rate? Are they going up? Are they going down? Right now, we're in a policy rate declining environment. The Fed is easing policy rates. So therefore, from a portfolio perspective, we want to keep durations extended. If you think about CSLIP's duration neutral, it would be about 30 days, right? We can run it as short as 1 day, as long as 60 days. So neutral would be about 30 days. So we're trying to run it above 30, 40-ish days, depending on cash flows, what's going on in the market, et cetera. So that's the cyclical approach we have in the portfolio. And then the tactical approach is what are we buying today? And as you know, we've got so much liquidity in the portfolio. We're ready to meet any sort of shareholder activity. And so every day we walk in, we have bonds that have matured in the portfolio, and we want to put those bonds to work. And so what are we going to buy today? If you look at probably the most recent market shock, it was back in April. And on the announcement of the tariffs, the market rallied dramatically because they thought the presidential tariffs that were being announced were going to crash the economy. And so we thought that the Fed was going to have to ease dramatically. So yields plummeted. We chose to step back from that from a tactical standpoint. We chose to invest in floating rate notes, something that would not lock in those yields at lower levels, and wait. And that patience worked. And in May, the market started to reprice, and so then we started to put money to work in those higher yields. So that's basically how we do it. That's our investment framework. So liquidity wise, we're always making sure that we have plenty of liquidity in the fund, more than what is required. From a duration, we're a little bit long duration right now. And then from an asset concentration standpoint, Ben, we definitely have concentrations amongst certain asset classes. But within that asset class, CPs, CDs, asset-backed commercial paper, there's always good diversification. And we're also making sure that we love the names that we're buying, and we do. These are GSIFI, globally systemically important financial institutions. They've got robust fortress-like balance sheets, and we feel very, very comfortable. We sleep very well at night, knowing that these names are in the portfolio. And they're all publicly available, so you folks on the line can look in and see exactly what we own. You can call us up anytime if you want to ask questions about it. We would love to take the call and chat with you about our credits and how we're thinking about the portfolio and how we're structuring the portfolio. So that's kind of it from a portfolio standpoint, Ben. Did I answer questions or all the questions, or is there other stuff?
I mean, just maybe elaborate a little more on the credit. Do you see any idiosyncratic or systemic risks in the market that could impact the fund? I mean, obviously, it's very hard to predict over the next 6 months, but anything that sticks out or kind of keeps you up at night?
Yeah, this is, everyone's remembering Jamie Dimon's comment, when you see one cockroach, there's probably others. And I get that. Yes, that's true. But not in our world. So essentially, what he was referring to is two companies in the auto sector that were engaged in fraudulent activity. And this is just the way the world is. There's always going to be some challenges with some bad actors. But when we look at the banking sector, one of the reasons that this economic cycle has been as resilient as it is, well, really two reasons. Um, but the main reason, for the purpose of answering your question, is that the banking sector has got double the amount of capital they had 2008, prior to 2008, and they've got liquidity like they've never had before. There's regulations now that require banks to own liquidity and to term out liabilities like they've never had to do. And so these banks have very, very strong balance sheets, really very strong balance sheets. And in fact, it's just almost, I don't want to say impossible because that's a terrible word to use, but it would be very difficult for a bank, a large bank that we would invest in, to get into trouble. It's not to say that smaller banks won't have problems, and we've seen that, right? In March 2023, we had some pretty big bank failures, but those are names that we're just not going to own in the portfolio. Um, People ask me often, like, what are sort of the first or second things you're watching when you're about to invest? And for the most part, we invest in financial institutions. That's just the nature of the beast, and that's just the way money market funds and liquidity pools operate. The first thing you want to make sure, after you've ticked off all of the major things, capital ratios, et cetera, is what is the deposit growth look like? You want very steady deposit growth. You don't want to see a bank taking in a whole bunch of money fast. You want very steady deposit growth. Um, and then you want to make sure that you've got a broad and diverse business, right? You don't want to see concentrations. And that's, what happened to those institutions that got into trouble. First Republic, we know that those institutions just grew so quickly, and that's what got them into trouble. So those names are not in our portfolio. We just couldn't get them on the approved list, and so we just wouldn't buy them.
No, that's very helpful. Very helpful, I think, in a lot of ways to not only stand risk, but how it's evaluated, and how it's avoided, in many ways.
Yeah,
Um,
yeah.
but I don't want to keep peppering you with questions that sound like
No, this
it
is
sounds
great.
like you
I
might
love
have
it.
something for me.
But yeah. So, you know, Colorado.
Mhm.
Let's talk about Colorado. Sales tax revenues. So you're out on the road, probably 8 days a week. Um, what are things looking like for the municipalities in Colorado through Q3? Any thoughts on next year on how revenues are looking?
Yeah, that's a great question. And it's changed marginally since our July and February webinars, where, a lot of the sales tax revenues that we're hearing out there between myself and Mr. Krug in our travels is that if sales tax revenues are up, they're only marginally up. I call it 1 to 3% or 2% to shoot right down the middle. There's a few outlying communities out there, one up in Northwest Colorado, a couple in the northern Front Range, and a couple in the southeastern part of the Front Range that do have some anomalies when it comes to above that 2%, rate. But really, a lot of the forecasts, some of our mountain communities are forecasting either 1% up next year for sales tax revenue growth, or I've heard as high as 2%. But really, erring on the side of caution and having a pretty large data set, what we've been recommending out there is for stable to no growth within there. And something that we're really working hard on is trying to forecast for our participants and local governments in Colorado what is a conservative interest earnings number for next year. And, I think last year so in 2024 going into 2025, I would have set a 3.75 to 4% for the aggregate portfolio between longer term securities, bank deposits, and liquidity funds such as CSLIP, the other three available in the state. It would have been a healthy number, I think. But this year, even with that potential for a third rate cut coming off the table in December, I mean, really, it's just going to kick the can down the road into the first or second quarter unless we have a change in economic data. So a lot of the numbers that we've been recommending out there, depending on the specific municipality. Counties are a little different, but on municipalities, a 2.75 to 3% range for an aggregate portfolio between all those allowable securities under Colorado revised statutes is I think, a very prudent expectation for next year. And really, we're going to have to kind of see what happens. I mean, as you mentioned a few minutes ago, is we got a rate cut, and then we saw some of the some of the liquidity funds actually see an increase. So it's really still hard to tell, but I always erring on the side of caution, under promising, over delivering when you're working with either your county commissioners, your city council, or your board of directors, if it's a school district or special district, I think is really a very good way to go. And our staff is always available to look at cash flows and really look at each individual entity and provide some guidance there. But I think that that's really what we can expect for next year. Colorado's had a really long run of high single digit and low double digit sales tax growth over the last decade. And I don't necessarily want to say that party's over, but I think we're getting towards the end of that run.
Yeah, well, that's interesting you say that, Ben, because we're seeing it in consumer behavior as well. We are seeing the consumer being a little bit more stretched, and we're seeing the high-end consumer, those that are most wealthy in the economy are the ones that will continue to spend, and then those that are, having a harder time paycheck to paycheck and whatnot, those where we've seen spending pull back there. And it's been, interesting to observe consumer behavior because the household balance sheet has delevered. We've definitely seen that. Certainly from where we were in 2008, delevered significantly, but we're starting to see credit card delinquencies pick up. And we're starting to see this other category of loans pick up, and that would be like a boat loan or a personal loan, maybe an RV loan, things that fall out of the auto category and the credit card category. That has started to tick up as well. But home equities and mortgage delinquencies are still very low, historically low. So I guess that's good for the housing market, but let's just talk a little bit about that. What does the housing and cost of living forecast look like in Colorado for next year?
I've been having a feeling this question was coming, trying to find a way to paint a rosy picture for everybody, but I'm all out of paint with that. Housing continues to be the biggest challenge that is faced statewide. And there are still some affordable communities left around the state that are seeing exceptional growth, being Grand Junction, being Pueblo, being south of Pueblo. We were at an industry conference down in Trinidad, and it was pretty impressive to see some of the growth that had migrated south down there. But when you get into resort communities, especially resort communities that have limited Airbnbs, VRBOs, vacation rentals, correct, to a very specific audience, primary homeowners, et cetera, it's a mess. Well, I'm trying to find a nice way to say it, but housing continues to be a problem. And what's extrapolating that housing problem is what I'd mentioned between a lot of these vacation rentals being owned by either investment companies, foreign entities, et cetera. I think a lot of the erosion of the millennials and older millennials like myself not being able to have the means to purchase homes is a lot of that supply was scooped up, and we haven't seen either that dump back into the market from either regulation on short-term rentals or a sell-off in short-term rentals, but also with baby boomer generation, we haven't seen a lot of those properties change hands yet. So I think that, not only here in Colorado, but nationwide, I may be getting over my skis because that's your neck of the woods, but here in Colorado, it's still going to be a problem. And income right now for average household income in Colorado is still showing a pretty significant gap of $25,000 to $40,000 per year, where it's not eroding more than half of your paycheck. And that's pretty geographically spread out around the state. Some areas are more expensive than others, and some of those affordable pockets are starting to be discovered within there. But I think, the income, not only here in Colorado, but it sounds like nationwide, continues to be a pretty big issue there. Now, I guess one silver lining is from what we've been hearing on some of our Front Range, specifically northeastern Front Range communities east of Fort Collins, and some of the resort communities of all the ski resorts you've heard of and the towns that are associated or counties around them, is the focus for a lot of the capital projects and bond issuances, at least from what we're hearing out there, is for housing projects. And, on bond issuances and compiling a lot of data for the CU Business Economic Outlook, we reached out to a lot of the rating agencies, and it sounds like credit ratings here in Colorado for public entities issuing debt have remained stable. Some of the large growth institutions, specifically Metro, Politan State University here in Denver, saw a minor downgrade, but none of them went to negative watch, which I think is great because S&P rates CSLIP, and working with a lot of those different rating agencies out there, it sounds like some of these housing projects, even if they're at the will of the voters, are starting to move forward. So I guess that's kind of a minor silver lining to my doomsday scenario of housing is still a problem especially when you add the gap of income versus what it costs to home ownership or an asset ownership.
Yeah, it's really interesting. I just was listening to an interview with Gavin Newsom out in California where they're taking single family homes and allowing them to be um, redistricted, I don't know, rezoned as two family,
Hmm.
which was really, I thought, a pretty interesting idea. I mean, I experienced in my Northeast region where, just people don't want new development, and, the whole not in my backyard, and it's a real challenge for the shortage. This is not dissimilar to developed nations worldwide. There's a housing shortage in Europe. There's a housing shortage in the UK. There's a housing shortage in Canada. Has a real challenge because they have had enormous waves of immigration, and in the United States as well. So this is definitely a global problem. Is finding places to put homes and being creative about how to give someone a place to live. So it's very interesting. So I hear you, and I feel your pain because we're experiencing something similar here. I look at my kids and I'm like, I don't know, I don't know how they're going to afford something. Okay, so what about, I'm just curious, you talked about some geographic regions there in Colorado, and I don't know if I heard you touch on sort of what's thriving and where there is some turbulence. Did I miss that? Did you touch that on the last one?
No, and thanks for circling me back on that. Sometimes I tend to get off on my tangents here, but some of the areas of the state that are doing very well, not only from a population growth standpoint, but capital expenditures at local governments, ease of debt issuances, are the Northern Front Range. When you get up into Fort Collins, but specifically east of that. And, this migration of wealth that we've talked about on previous webinars or podcasts, if you will, depending on how you want to interpret these, but is the wealth in these concentrated areas, whether it's a resort community or high population density counties, is starting to push some of those lower income households out into neighboring communities. So when you see this migration, it's happening northeast of Denver and specifically south into Denver. And Pueblo in 2024 was the fastest growing county in the state. And some of the newer data that I've received recently is Grand Junction and Mesa County. Are one of the fastest growing real estate markets in the state, but also from a population migration standpoint. In Central Mountains, it's a very unique demographic that can just pick up and move to, say, an Aspen, if you will, or a Roaring Fork Valley, for that matter. So, I think that a lot of those communities, continue to thrive because the demographic that tends to migrate there looks a little different than what you would see in the southeastern part of the Front Range. But really, we are starting to still see growth here in the Denver metropolitan area. It looks like population growth is back to almost pre-COVID levels, with above 4,000 people per month moving here is kind of the average of some of the data sources that I'm compiling out there. But those are, really the areas that stick out. Now, some of the areas of the state that are not doing well, Northeast Colorado. A lot of the counties and communities up there are having many issues, and a lot of it is related around housing, but also diversity of economy and how far they're willing to drive to potentially do a skill set that they have turned into a profession or have worked to develop. So, Northeast Colorado is a struggling area, and we've had some pretty catastrophic Mother Nature events in the south central part of the state that it really remains to be seen, what those impacts are going to be. And we did have some pretty significant fires this year, especially up in Northwest Colorado. We were a little worried that we were going to lose one of the towns up there for a couple of days here. So, I think that some of the economic data out there is still a little fresh for us to be able to give, some hard numbers on that. But from a trend standpoint and from an information standpoint, that's some of the areas that we hear are thriving and struggling a little bit.
Got it. Okay. Um, all right, let's pivot a little bit, Ben, and talk a little bit about some of the highlights for CSLIP over the last couple of quarters. What's there to talk about there?
Oh, thanks for that. Well, I think a big highlight, to start with is Mr. Krug, Bob Krug, joining our team back in mid-August. Um, Really being a stalwart within this industry for 28 years, it's great to have him on the team. The portfolio did hit $500 million a little over a month ago, and we kind of trailed off a little bit since then with bond proceed payments, et cetera. But the portfolio is still thriving very well. We're up to over 25 participants, not just on the Front Range, really spread out all over the state. So with the addition of a couple new board members as well, but really those are some of the big highlights out there. Even though this isn't designed to be a commercial CSLIP, the story and the approach that we're taking really is starting to grow. So thanks for asking. I appreciate that.
Yeah, excellent. I know we'll have a bonus question, but I did want to just touch on one thing that I think people are probably interested in, or maybe just more of a curiosity. And that is, we hear a ton of talk about stable coins. We hear a ton of talk about tokenizing assets, blockchain, blah, 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 blah. And it has been a real buzzword lately. And so I'm getting a lot of questions from folks about what does this mean? What do I do with it? What's going on? So in my opinion, the bottom line is, crypto's not going away. Stable coins aren't going away. It's definitely here. It's here to stay. The challenge so far is that there's no institutional adoption because we're just not there yet. And I'll give you a quick example. Everyone's probably used Cash App. Everyone's probably used Venmo at some point, or maybe Zelle, to move small amounts of money between friends without having to, give them a $20 bill, physical currency, et cetera, write them a check, et cetera, et cetera. So we're starting to see more and more of that. It hasn't come into the institutional space yet. And I'm going to give you a quick little history on money market funds. Money market funds were created in 1971, and they were really created to capture money at mutual fund houses. When you sold out of your Dow Jones Industrial Average index fund or your mutual fund that you owned, rather than moving that money back to the bank, you kept it at the mutual fund house in what was called a money market fund, and it had a different accounting method that we're all grown very accustomed with now. And that was a very clever way for that mutual fund company to keep that money there. Same thing's going on in crypto now. When you
Mm.
sell out a Bitcoin, you keep the money at that on that platform in a stable coin. It took 20 years, really a little bit more than 20 years, for money market funds from the 70s. It really took all the way until the 1990s for institutions to adopt it. Now we know liquidity pools, state liquidity pools, very unique to those states. We saw the creation of some of those pools back in the 70s, some even earlier than that. But that was sort of slow adoption, and we went through a whole bunch of speed bumps. So that's the comparison I'm drawing there, and how I think the evolution. I think it's going to go a little bit quicker, but we really need to put technology on your doorstep that is something you can plug into your system, something that you can use easily before we're going to start to see broad adoption on that side of things.
That's
Um,
great. That's great. That was something I was thinking about this morning. Do I ask Will that or do I not? And that was great that you volunteered that. And if I may, Will, I just want to say for the audience that is attending the CGFOA conference coming up, not next week, but the following, will be speaking on Thursday afternoon at 2 o'clock on the differences between local government investment pools and money markets. And if you happen to be in attendance, feel free to come see us and we'll introduce you to Will. But I know we're almost out of time here, and I did want to open up to the audience to see if there was any questions. You don't have to turn your camera on, just unmute yourself if you want to ask a question, or if you're more comfortable sending it in the chat, we can do that. But we are here as resources for you. We're happy to address any questions offline as well. But we wanted to see if anybody from the audience has any questions or thoughts or comments or wants to tell us we're out of our minds, whatever it may be. I guess, Will, you must have completely bedazzled the audience on.
I was going to
Uh,
say you did too, Ben, but I have a bonus question for you.
okay, all right.
Um, so now that we're entering the property tax collection cycle,
Mhm.
do you have a forecast assessments or values for next year?
Oh, yeah, that's the question of all questions. As usual, it's very well spread out, and we do have a couple of county treasurers on the phone, but it is very well geographically spread out. And compiling data from a lot of the assessors that um, set the values is we're not expecting a massive jump like what we saw in the last assessment 3 years ago, where my county, being Denver City and County, was 55% increase. Really, we're expecting single digit increases, at least on the residential side. Commercial can always be kind of a mixed bag, especially when you get into some of the areas that have oil and gas or agriculture or different taxing methodologies, correct? From a size, and there's many different components that go in there. But I guess for a long answer short, we don't expect high double digit increases, for the next 3 years. And I don't know how much more tolerance homeowners and business owners have for these types of growth. But as long as our mountains keep being mountains and people keep moving here and our sun keeps shining 300 days a year, I don't know that we're going to stop the population increases, which grows the population base, which if we're not adding homes, as we've discussed, it's going to increase the values, right? Less supply, more demand, price goes up. So I think the outlook for at least this assessment, and hopefully I don't get some nasty emails from some of the county treasurers on the call, but I think on this assessment, it'll be relatively tolerable from what we're hearing out there. But there are going to be some communities that have some less than ideal property tax increases, but those are, I think, the outliers.
Appreciate
So,
that.
yeah, great question.
Tara, did you have a question? You are unmuted.
Well, Miss Thompson, if she has a question, I'm sure we'll hear.
Okay.
And it is good to see you on the phone, Tara. Thank you for joining. With that, unless anybody has any last minute thoughts or questions, we have recorded this. We will put it on the website later. So if you want to rewind 6 months and see how wrong we were, you're welcome to do so. But also for any of your staff or people that weren't able to join, feel free to point them towards our website. Under education, you'll see the recordings from this webinar and previous webinars. And we do appreciate the support of the Colorado local governments in Colorado that are currently participating in CSLIP, and the ones that aren't, we're here to help you. So thank you for that. We appreciate everybody's time today. And Will, thank you. I really look forward to these sessions.
Yeah, thank you, Ben. Good conversation. I learned something.
All
Appreciate that.
right. Likewise, Will. Have a great rest of the day, sir.
Thank you. You too. Bye bye.
Bye bye.